One of the questions that many have is the stock market overvalued? This is the very question that the Shiller PE ratio was designed to answer. But to better understand how this ratio came to life, we should go back to the 1930s to the popular value investors Benjamin Graham and David Dodd. In their classic book, Security Analysis, they mentioned that one-year earnings are just too volatile to offer a good idea of a company's true earning power. They argued that smoothing earnings over the past 5 to 10 years is a much better approach that not only smooths out the business cycle's ups and downs, but also removes the one-time events that affect the company's profitability in a given year. So far, all of this makes perfect sense, right? Well, the Shiller PE ratio, also known as the cyclically adjusted price to earnings ratio, is a valuation measure that is based on the average earnings of the past 10 years, but it has a slight twist. The earnings are also inflation adjusted. To some extent, this should ensure comparability over time, making the ratio a useful tool for historical comparisons. At least that's what one should expect. Of course, a ratio of this kind isn't appropriate for unprofitable or high growth companies, but it should do a better job for mature, stable companies as well as broad indices. The ratio has often been used to assess whether the market as a whole is overvalued or undervalued. It has been used to predict future stock market returns, where extremely high values have been associated with lower future returns, and vice versa. Now, if we take a look at this chart, what do we see? Today, as I'm recording this video, the ratio is significantly above the historical average of 17, but there is still some room to the 44 of the dot-com boom. The conclusion at first glance is that the market measured through the S&P 500 is significantly overvalued. This conclusion, although supported by the chart, could be wrong, and there are many factors that we should consider. Using the Shiller PE ratio in isolation is like eating a soup with a fork. Sure, you will get something, but you're missing a lot. So I did quite some research, and my main question was, what is this ratio missing? First of all, the composition of the index is different. You might ask, wait a second, what do you mean the composition is different? Allow me to elaborate more on this through an example. Imagine there are two companies that have the same earnings. One is a traditional, old-school manufacturing company, and the other is a software or technology company. Which one is more risky? The average manufacturing company has a bigger portion of its costs as fixed. So, if we are in a more challenging environment, reducing costs would be a very, very difficult task, and the company's profitability will be significantly impacted. On the other side, managing costs for a software or technology company is a much easier task, as fixed costs account for a much lower proportion of the total costs. There is also another aspect to take into account: the capital investment required to grow. For a manufacturing company to double in size, it will likely need to have twice as many factories, twice as many employees, twice as much inventory, and so on. If something goes wrong in this expansion process, well, it will harm the business heavily. So it is quite capital intensive and somewhat risky. However, the average software company is capital light. It doesn't need as much investment to double in size. The conclusion is clear. The average software or technology company is less risky than the average manufacturing company. Now the question is, how would this reflect in the price? If a software company is less risky, it should be more expensive and have a higher PE ratio. Over the last few decades, there has been a significant shift in the composition of the S&P 500 as more software and technology companies such as Microsoft, Apple, Meta, Alphabet, and many others became a significant part of the index, replacing the traditional manufacturing companies. So the index as a whole, with the current composition, should naturally have a higher multiple. The second factor that isn't taken into account is the interest rate. There were times in the past when the interest rate was above 10%. At that point in time, investors would demand a higher than 10% rate of return in order to invest in the stock market. Using a higher discount rate would lead to a lower price that the investors are willing to pay, which would subsequently lead to a lower PE ratio. The interest rate over the last decade, on the other hand, has been much lower, so naturally, we should expect a higher Shiller PE ratio. The third factor to take into account is the capital allocation of the companies. In the past, the companies used to distribute majority of their earnings in the form of dividends. The payout ratio was at times above 60%. Recently, it is below 40%. What that means is there is more cash retained within the companies to reinvest, which will lead to a higher earnings growth. So the future is expected to be much better than the past. Lastly, we should take a look at the advancements in technology, currently most notably the impact of AI and automation. If these advancements have a significant positive impact on the earnings of the companies that are part of the index, well, the backward-looking earnings aren't a good starting point. If the future earnings growth is already anticipated by the investors, they are willing to pay higher price for it, which again leads to a higher Shiller PE ratio. Without taking these four factors into account, the conclusion would be that the S&P 500 is significantly overvalued based on the Shiller PE ratio. After taking these four factors into account, it is quite clear that using the average of the last 100 years isn't a good starting point and should not be used as a benchmark. The world today isn't the same as it was 2 decades ago, let alone an entire century. Therefore, it can be argued that the S&P 500 isn't as overvalued as it seems through this ratio. Professor Aswad Damodaran had an appearance on CNBC recently, and based on his calculations, the S&P 500 is overvalued, but by only 10%. His approach is based on estimating the future earnings of the index and then discounting with an appropriate discount rate. Of course, this is a very solid approach, but it is also time-consuming as it takes many inputs, including the interest rate and the future earnings growth, inputs that are not taken into account with the Shiller PE ratio. Does all of this mean that the Shiller PE ratio is completely useless? Well, it depends. If you use it on its own, then probably yes, not only useless, but in many cases misleading. In fact, over the last decade, the Shiller PE ratio is above 25 and the S&P 500 is up 180% during this period. Then you might ask, why is it still around and used by many? Because as human beings, we are oftentimes lazy. And if there was one ratio that answers our questions, then great, let's do that. Let's use that ratio. Unfortunately, there is no single ratio that can answer this question. It can definitely provide some insights into market valuations if the other factors are taken into account. The next time you stumble upon a ratio, it is always good to understand how it came into existence, what is the logic behind it, and even more importantly, what are its flaws. That will help you understand what other data you need that complements or completes the incomplete picture provided by this ratio. As already mentioned, market conditions, economic factors, advancements in technology, as well as investor sentiment can all influence the effectiveness of this ratio as a predictive tool. Now, one more note before the end of the video is some countries, some indices consist of as few as 10 companies. So if one or a few of these companies are much larger than the rest in size, they will be a much larger portion of the index. Hence, any ratio will be more skewed towards those particular companies. When this is the case, even though it is an index, using this ratio to assess the valuation of the entire market would be irrational, as clearly the index doesn't represent the market, but one or a few very large companies. If you found this video interesting, feel free to subscribe. After all, it's free and it helps the channel. I'd love to hear your thoughts about the ratio, as well as whether you think the market is overvalued or not. Thank you for following the video until the very end, and as always, see you in the next one.